If you are retired and receiving Social Security, there is a very real chance that an old tax return, one that is 2 years behind you right now, is quietly controlling how much of your own money you actually get to keep each month. Not your current income, not what you are living on today, a return from years ago. And if that older return showed higher income, which can happen easily after selling a home, converting a retirement account, or going through any major financial life change, you may be paying significantly more for Medicare than you should be. The extra charge does not arrive as a separate bill. It is deducted directly from your Social Security deposit before the money ever hits your bank account. Millions of people are seeing a smaller deposit every single month and assuming that is simply how the system works, not realizing they may have the right to appeal it, reduce it, and potentially keep hundreds of dollars more every single month going forward.
And there's a second issue that runs alongside this one,
And it is just as important. If you are approaching the age when Social Security becomes available, or if you have already claimed but are not certain whether you claimed at the right time for your birth year, the size of your monthly check may have been permanently locked in at a lower number than you realize. The rules around when to claim, what your actual full retirement age is, and what happens to your benefit based on the exact year you were born are different for different groups of people. And the consequences of getting this wrong are not small. They are permanent, and they compound across every check for the rest of your life. This video is going to walk through both of these issues carefully, in plain English, and by the end, you will know exactly what to look for, what form exists to fix the Medicare issue, and how to make sure the Social Security decision you make is based on the rules that actually apply to you, not the rules someone told you about years ago that may no longer be accurate for your birth year. I went through the current guidance from the Social Security Administration and Medicare, including the specific rules around income-related premium adjustments, the official appeal process for life-changing events, the full retirement age tables organized by birth year, the earnings rules that can temporarily reduce a check, and the delayed credit calculation that most people never take the time to run through. None of this is buried legal language. It has all been translated here into the kind of plain explanation that the agency itself does not always provide unless you ask the exact right question. If you are not subscribed to this channel, take 5 seconds and do that now. Medicare premiums change every year. Social Security rules are adjusted regularly. The income thresholds that trigger a surcharge shift annually. Subscribed viewers get updates before deadlines pass and before a rule change costs them money they could have protected. It is a small step with a real benefit. Now, the first thing to understand is the Medicare surcharge situation, and this one catches people off guard because it does not announce itself. When Medicare calculates your monthly Part B and Part D premiums, it does not look at what you earned this year. It uses your modified adjusted gross income from 2 years prior. The Social Security Administration receives that data from the Internal Revenue Service. And if that older return showed income above certain thresholds, an additional amount, sometimes called an income-related monthly adjustment, is automatically added to your premium. This adjustment is not a flat fee. It increases on a sliding scale depending on how high that older income appeared to be. The extra monthly charges can range from a relatively modest addition to well over $300 more per month above the standard premium at the higher income levels. At the top tier, some people are paying over $4,000 more per year just in Medicare surcharges. And every dollar of that is pulled directly from their Social Security payment before they ever see it. Here is what makes this so easy to miss. People who retire often have one unusual income year, right at the edge of retirement. You may have sold your primary residence and recognize the capital gain.
You may have followed advice to convert a traditional IRA to a Roth IRA, which is a very common and often smart move, but one that temporarily pushes your income high on paper in the year of the conversion. You may have received a final bonus, a pension lump sum, proceeds from selling a rental property, or some other one-time financial event that made a single year look far more prosperous than your actual retirement income picture. 2 years later, Medicare examines that one unusual year and prices your premium as though you are still earning at that level. You are now living on a fixed income, watching your Social Security deposit arrive lighter than expected, and the system does not flag this, explain it, or suggest that anything has gone wrong. The second thing to understand is that there is a process specifically designed to fix this, and most people never hear about it.
The Social Security Administration has a form, Form 44, and its entire purpose is to address exactly this kind of situation. If your income drops significantly because of a life-changing event, you can file that form and ask the agency to use your more recent, lower income figure instead of the older return that triggered the surcharge. The qualifying life-changing events that make you eligible to file include retirement itself, a reduction in work hours, divorce, the death of a spouse, the loss of a pension, and the sale of income-producing property. Read that last one carefully because a lot of people overlook it. If you sold a property and that sale is what inflated your older return, and your income now is significantly lower, you likely have a qualifying event. You can document your current income situation using a recent tax return, a benefit statement, or a letter from your employer, and ask the agency to reassess your premium based on where you actually stand today.
This does not happen automatically. Medicare is not monitoring your income year to year to check whether your life changed. The agency will not send you a letter that says, "It appears your financial situation has shifted. Would you like us to use a lower number?" The form exists and the process is available, but it only works if you know to initiate it. For many people, filing Form 44 results in a meaningfully lower monthly premium within a few months, which means more of their Social Security check stays in their account going forward. That is a real, monthly, lasting benefit that is available right now to people who took a one-time income hit they never expected to count against them the way it does. One call to the Social Security Administration or one visit to the official Social Security website to download the form is often the only thing standing between paying the higher charge indefinitely and getting the correction that was always available. Most people spend more time reviewing a restaurant bill than reviewing the record that controls their Medicare premium.
That is worth changing today. Now, the third issue is one that surprises people even when they have been planning carefully, because the assumption that Social Security has one fixed retirement age is deeply rooted and quietly wrong. The full retirement age, meaning the age at which you can collect your full benefit without any permanent reduction, is different depending on the year you were born. This is not a new change. It has been in place for decades. But an enormous number of people still carry the old belief that the magic number is 65, or have heard 67 and applied it as universal truth, or simply have not looked up which rule applies to their specific birth year. Here is how the birth year groups actually break down. If you were born in 1954 or earlier, your full retirement age is 66.
If you were born in 1955, your full retirement age is 66 and 2 months. Born in 1956, it is 66 and 4 months. Born in 1957, 66 and 6 months. Born in 1958, 66 and 8 months. Born in 1959, 66 and 10 months. And if you were born in 1960 or any year after that, your full retirement age is 67. That means two neighbors who retired the same year, one born in November of 1959 and one born in February of 1960, do not share the same full retirement age. The person born in February has a full retirement age 2 full months later, and if they claimed at the same time without knowing that, one of them took a slightly larger reduction without realizing it. That sounds small until you understand what early claiming actually costs. If you claim Social Security at 62, which is the earliest permitted age, your monthly benefit is reduced by as much as 30% compared to what you would have received at your full retirement age. That reduction is permanent. It does not adjust when you reach full retirement age. It does not catch up over time. For someone whose full retirement age benefit would have been $2,000 per month, a 30% reduction brings that down to around $1,400 per month. That is $600 less every single month for the rest of their life. Over a 10-year period, that adds up to $72,000. Over 20 years, the difference is $144,000. This is not a minor adjustment. It is a foundational difference in retirement income, and it is locked in by a single filing decision that many people made without fully understanding the math or the permanence. The fourth point is where even careful, well-informed retirees sometimes get tripped up, and it involves something called the earnings test. This rule applies to people who have claimed Social Security before reaching their full retirement age and who are still earning money from work. If you are in that situation, working part-time, consulting, or running any kind of business while collecting benefits, and your earned income exceeds a certain annual threshold, the Social Security Administration will withhold a portion of your benefit. The threshold is adjusted each year, so the exact figure varies, but the general structure is consistent. For every $2 you earn above the limit, $1 is temporarily withheld from your Social Security check. This is not a permanent penalty in the way that early claiming is, because the withheld amounts are factored back into your benefit once you reach full retirement age, and your monthly payment is adjusted upward at that point. But the short-term reality is a check that arrives smaller than expected, which can disrupt the carefully planned monthly budget and cause confusion that takes time to sort out. The practical solution here is straightforward. If you are under full retirement age, you are working or planning to work, and you are already collecting or about to collect Social Security, call the Social Security Administration directly and tell them what you expect to earn. Ask them how the earnings test will affect your specific check. The agency can walk you through the calculation before the problem shows up in your deposit. That one phone call prevents the kind of surprise that leads people to call in a panic, wondering why their check is short, sit on hold while they work out the explanation, and scramble to adjust their budget in the meantime. The rule is not designed to hurt you. It is designed to adjust the timing of benefits, but it only makes sense when you understand it in advance. And the agency does not proactively reach out to explain it when you file. The fifth point is the one that the fewest people take full advantage of. And for healthy retirees with other income sources, it may be the most financially significant decision they will ever make. If you wait past your full retirement age to begin collecting Social Security, your benefit grows by 8% for every full year you delay. That growth continues up through age 70. After age 70, there is no further credit for waiting, so there is no reason to delay past that point. But the range from full retirement age to age 70 represents a powerful window. Depending on when your full retirement age falls, waiting until age 70 can increase your monthly benefit by as much as 24 to 32% above what you would have received at full retirement age. For someone with a full retirement age benefit of $2,000 per month, that could mean receiving $2,500 to $2,600 or more each month instead, for the rest of their life. The question of whether to delay is not a simple yes or no.
It requires thinking through what your other income sources are, how comfortable you are financially in the years between your full retirement age and age 70, and what your health and family history suggest about how long you are likely to receive benefits. The break-even analysis is the essential tool here. In most cases, the break-even point for delaying from full retirement age to age 70 falls somewhere in the mid to late 70s. If you live past that point, which many people do, you come out significantly ahead by having waited. If your health situation suggests a shorter timeline, claiming earlier may serve you better. The important thing is to run that analysis deliberately, with your actual benefit numbers, rather than making the decision based on habit, impatience, or what someone told you worked for them. There is one more dimension to this that is almost never mentioned in casual conversations about Social Security, and it matters deeply for married couples. When a higher-earning spouse claims early, they permanently reduce their own benefit. That lower benefit becomes the foundation of the survivor benefit that the remaining spouse receives if the higher earner passes away first. The widow or widower is then living for the rest of their life on a benefit that was permanently reduced by a decision made years or decades earlier. This consequence does not announce itself at the time of claiming. The claiming form does not say, by the way, this decision will also affect your spouse's survivor income. But it is real, and the impact can be substantial over the years a surviving spouse lives on that income. If you are married and one of you earns significantly more over your career, it is worth sitting down together, reviewing both of your estimated benefits on the official Social Security website, and thinking carefully about the sequencing of who claims when and at what age. Going back to the Medicare surcharge question for a moment, because there is one more thing worth saying. Many people who went through a high-income year think of the surcharge as a temporary inconvenience that will eventually fade on its own. And technically, yes. As years pass, the older high-income return ages further into the past and eventually out of the 2-year look-back window. But that waiting process can take time, and in the meantime, the higher premium keeps being deducted from every Social Security payment. If you qualify for the life-changing event appeal right now, you do not have to wait. The process exists because lawmakers recognized that a one-time income spike from selling a property, converting a retirement account, or any other non-recurring event is not a fair basis for a permanently elevated premium. And they created a correction path for exactly that reason. The Social Security Administration processes these reviews regularly. People file them and receive approval. The question is never whether the process works. The question is whether you know it exists. And that is really the central truth behind everything covered in this video. The system does have corrections built into it. The forms exist. The appeal process is real. The delayed credit calculation is accurate. The birth year benefit tables are sitting on the official Social Security website right now, available to anyone who looks. None of it is hidden in the sense that it is classified or locked away. But none of it comes looking for you either. The agency does not send a letter to say your premium can be reduced. It does not flag the moment your benefit would grow by another 8% if you wait a little longer. It does not call to let you know that a different claiming strategy might leave your spouse in a stronger financial position. The difference between getting this right and missing it entirely is usually just knowing what question to ask, and then taking the one step that asks it. So here is the full picture. If you are on Medicare, your monthly premium may be based on income from a year that no longer reflects your financial reality. And Social Security Administration Form 44 is the form that gives you the right to ask for a reassessment. If you are approaching Social Security or have recently claimed, your full retirement age is determined by the year you were born, and it is not the same for everyone born before 1960 and everyone born after.
Claiming before your full retirement age creates a permanent reduction in your monthly check that can cost you enormous amounts over a full retirement. Working while collecting before full retirement age triggers an earnings test that can temporarily reduce your deposit, and knowing about it in advance is what prevents the confusion. And waiting past full retirement age, up to age 70, grows your benefit by 8% for every year of delay, a calculation that is worth running with your actual numbers before you decide. For married couples, the claiming decision also shapes the survivor benefit, and that long-term consequence deserves serious attention before the filing is done. None of this arrives at your door with a clear explanation. The difference is knowing what to look for and making that one call, sending that one form, or spending that 1 hour on the official Social Security website, reviewing your actual estimated benefit. If this video gave you something useful, please share it with anyone in your life who is on Medicare, approaching retirement, already collecting Social Security, supporting a parent, or managing a household on a fixed income. This information could matter more to them than they realize. And if you are not subscribed, this is the right moment because these rules are updated every year, and you want to be the person who finds out before the deadline, not after.